Welcome back, everyone, to another episode of Let's Talk Housing. My name's Brennan Thomas, and if you don't know me already, that's pretty crazy. I am the co-host here alongside Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent economic news and statistics, a little bit on 2025, new build apartments, baby boomers, home insurance, and just so much more like usual. But first, Steven, what is going on in the Thomas household?
So, the Thomas household. Well, they were all gone for Thanksgiving break. Now everybody's back to school. Everything's back to normal. Just winding up with some finals coming up. And then it's the holiday break. The week that they get off for Thanksgiving's just like a little teaser that's leading up to their holiday break, which is coming up. Can't wait for it. I'm very thankful for my wife who does most of the Christmas shopping, and she gives me like a tiny little list. So my hat's off to my wonderful wife. And but that's what's going on in our neck of the woods. Not a whole heck of a lot. Everybody's wrapped up all their sports right now, so we don't have to. Oh, I'm fibbing right now. Actually, we do have Zeke is in basketball. He's in this winter basketball league, and he's been started playing basketball. I'm 6'4", and I have been told I should play basketball. I'm not very good other than standing in front of the backboard and getting rebounds. But and I couldn't teach it at all. Ezekiel was on the playground playing lots of basketball with his friends and said, "Hey, can I play basketball too?" So he's in a basketball league. That's just how it works with our family. But we have no clue as to what we're doing, what we're rooting for, and all that stuff. I mean, we've watched enough NBA and stuff, but we couldn't coach it or anything. We don't know the different plays. But nonetheless, lots of fun. He has practice once a week on Mondays, and then he has games on Fridays, and it's a lot of fun. So that's what's going on. It's right now just basketball and finals. How about you, young man? What has been going on in your neck of the woods?
Well, I would love to speak on Arsenal, my soccer team, but just going through a little bit of a slump. So it's a little bit rough right now. Looking to get through these difficult times, I guess. It's a little struggling period for maybe a stronger second half, but still so much fun to tune into. And then tomorrow night, on the day that we're actually uploading this podcast, I will be seeing Fleet Foxes in concert, or at least the main singer, which is just super crazy because I used to listen to him while studying all my economic courses, and it's just a bunch of good stuff, and it just reminds me of that time, and it was a lot of fun. But I'm looking forward to that. I've been looking forward to that forever, and now it's finally here, another concert, and I am so excited. So that will be amazing. And other than that, is I'm just ready for the holidays. It's here, and I'm ready to let it pass us by, just like super quickly, like always, of course. But Stephen, what's happening in the real estate world with supply, demand, and our very own expected market time over the past couple of weeks?
Hark, the herald angels sing. That's the holiday market. We're in the midst of it all right now. We're knee deep in the holiday market, which began a week before Thanksgiving. Real estate caught a break, and they actually had an extra week of good activity because housing really slows the week before Thanksgiving. And this year, Thanksgiving came late. It came in the very last week of November. And last year, there was still another like almost full week of November. So there was an extra week. So basically, it's from the week before Thanksgiving to the first couple of weeks of the new year. And what happens right now is we're just getting demands coming down, but in many markets, inventory is coming down faster. And what's interesting is prior to COVID, what you had was inventories would come down, but demand would come down faster, and that meant that the market slowed. This since COVID, what's happened is we've actually had inventories come down quite a bit, and demand's come down, but not quite as much. And that's because demand's already relatively low, so it doesn't really plunge. So with inventories coming down faster than demand, we actually get markets that speed up at the second half of December, contrary to what everybody thinks out there. This is the best time to purchase because sellers are just languishing. Now, nobody's in this really have-to selling mood, so there's a lot of people pulling their homes off the market that have been unsuccessful. And December's home to the fewest number of homes coming in the markets. The combination of the two is really driving down the inventories. Demand, on the other hand, with interest rates that have been keeping below 7% for the most part over the last couple of weeks, it's really helped nudge things along to keep demand from really coming down that far, even though it is coming down, but it's just not coming down as fast as supply. So markets are improving pretty much across the board. There's just maybe a market or two where this doesn't fit completely, but this is the overarching theme that's going on right now. And this will continue until we ring in a new year. And then once we ring in a new year, all of a sudden, after the first couple of weeks, demand will really heat up. But the inventory takes a while before more homes come on the market because December's the fewest, November's the second fewest number of homes come on the market. January is really not home to a bunch of homes coming on the market. Neither is February. It's really got to get to the meat of the market starting in March. So their demand will outpace the increases, the increases in inventory. So the market heats up at the beginning of the year, every year. And everybody in the real estate community right around Super Bowl, which I call Valentine's Day, perfect time to get in. And that's kind of where things are headed.
And what have you noticed in the economy over the past couple of weeks as well?
So as far as the economy is concerned, the big one was Jobs Week last week, and it's kind of like a nothing burger. Wages were a bit higher than what really the Fed would really like, and so actually wages are outpacing inflation right now, which is a good thing, but it can't keep on doing this. This is not something that the Fed wants, because what it does is puts more pressure on inflation if wages continue to rise faster than inflation. So that's kind of an issue. But and unemployment was flat, and then the number of jobs created was a little bit higher than expectations, but not much. So it's just a big nothing burger last week as far as jobs were concerned. We did get a manufacturing report that came in less than expectations, and that really drove down interest rates last week. So right now we're playing right at about 6.75%. We were a little bit lower on Friday, and it's come up on Monday and Tuesday of this week, and then this thing is released tomorrow on the 11th. And so we're getting interest rates that rise a little bit, but not a whole heck of a lot of economic activity yesterday or today. So we're waiting on more economic activity. And the longer that we're waiting for economic activity, what has been the case recently is that about a day before we get interest rates that rise, and then a day before we start to see interest rates drop a little bit the day before, and then we get the release. So that's kind of how things have been working so far. If anybody's trying to time anything, which I don't think that anybody should be timing interest rates, because that's more of a shot in the dark. But that's kind of what's been going on. More than anything else is Jobs Week. That was the big week we were waiting for. It really wasn't mounted to hardly anything at all. So a little bit sad. I was hoping this would be below expectations so we can see rates get below 6.5%. But you know what? Nobody can forecast where these things are going to come in. So we're not in that kind of a forecasting business. We're looking at the numbers and seeing what they mean so we can tell you where the market is headed.
So with the Federal Reserve holding a press conference on what they will do with interest rates on December 18th, Steve, after the jobs data we just witnessed, what do you believe the Fed will do at this upcoming meeting?
Cut a quarter. And if you listen to the Fed, it sounds like that's precisely what they're going to do. But they've been already kind of like articulating where they want to go after this, and it's kind of like up to this point, they've talked about all the rate cuts. They did the two, equivalent of 2 in September. They did 1 2 days after the election of 0.25%. So now they're down 3/4. And then the fourth one will come a week from tomorrow. on the 18th. Now, we expect them to cut another quarter because that's kind of what they've already been setting the stage for. But beyond that, it's kind of like a shot in the dark. We're going to have to see what happens to the economy, and they're going to have to. There's a few things that they're going to be watching before they pull the trigger further and continue to do consecutive rate cuts. You'd really start to have to see some slowing in the data a little bit more than what we've seen so far, because I think that they're going to wait. They're going to take a more of a wait and see attitude because they've done so much in the front side. Which, if you remember, back in June they called for 1 rate cut for this year, and this will be 4. So they've done quite a bit, and now it's kind of like sit back and wait. And if things continue to slow, then it'll give them the ability to cut further. So we will really be watching data going forward, as will the Fed, and that'll articulate where they're going to go from here. But that's what they're going to do next week. But we'll see from there.
So I know that you have a little bit of an issue with the month of October in the past couple years. So why was October such a strong month for sales when rates were pretty elevated?
Aha! Because today's rates don't manifest themselves in today's closings. September was where we were at 6.1% interest rates. And then they came up a little bit, but they continue to be they were nice and low, but then they continued to drive higher and higher and higher until they got up above 7% yet again. They went up a full percentage point after they did the 0.5 point rate cut. And with that full percentage point, people were like scratching their heads. But that's because the interest rates already have in the rate cuts baked in. And then as more data points come out, that kind of tells us where rates are going to go in the future and how the Fed's going to act in the future based upon today's data points. So that's why we get these big changes. And yeah, in October, we might have had these 7% interest rates, but the closed sales data was a reflection of pending sales that were placed into pending status back in September when rates were really favorable. That's why we had this bump. And it looks like we're going to get another bump in the month of November as well. But that's okay. That also has to do with a lot of people locked and their pending sell status was a little bit longer, and we're just going to get more. It'll be interesting to see what happens to December year over year. And also something else to look at is the number of where we were at a year ago. Up until now, interest rates were higher last year compared to this year, so which means that there'd be more demand because the interest rate environment has been a bit more favorable. Even at 7%, compared to last year, where it was 8%, they're more favorable this year. So you could see how that would translate to more pending sales, which would be higher pending closed sales year over year for the months of November and December. So we're actually anticipating more closed sales in the month of December. From there on, now it's kind of like year over year the same. It'll be interesting to see because we got to 6.7% interest rates, which is kind of where we're at right now in December of last year. So we'll be on par. So it'll be interesting to see where we go from here.
The topic of discussion is if jobs switch back from being mainly online to in office, could this potentially have an effect on real estate?
Sure, you are getting some pushback on this, at home work environment, but there will always be this deterioration of the office in office or in office for 5 days a week. There are some old school and even there's some new school that still believe in it, but it's not going to be the predominant path going forward. I think the base case is that there will be some in office and some at home, and so at home will always exist now. And the COVID pushed the envelope a bit, and it was already starting and made it so that a lot of people preferred it. But then there's this pushback and there's this going back to the office. But over time, it will continue to balance out, and there will be more people that work from home eventually. But the in-office will drive some real estate activity for those people that moved out of area. that or moved up to a cabin in the mountains, those are the people that need to go back. They need to be closer to their work. That they will come off the mountain and maybe sell their real estate. So there is a bit of movement now because of that, but it's nothing that's gigantic. But there will be movement because of the you have to come back to the office mentality. That's kind of been talked about quite a bit, but we're not going to go back to where it was. That's for sure.
Similar to when people hold off for an election, could there be people waiting for Trump's administration to enter office in January?
Yeah, you're going to hear this kind of stuff all the time. There could be some, but I don't. I think rates is the driving force of our of the real estate ecosystem, and where right now it's actually, you could say that housing is at the mercy of mortgage rates, and as rates come down, you'll see that the overall housing market thaws out, and if it gets below 6.5%, we'll see a real thawing. If it ever gets below 6%, which eventually someday it really will thaw out considerably. But but when rates are higher, that's when we have a problem. So I think that's really the driving force, the gas pedal for the housing market. And there will always be people that give perpetual excuses as to why they're waiting. It was, I'm going to wait till after the election, and then that same person was, well, I'm going to wait till after we have the new administration, and then it'll be after the first snow in SoCal. I mean, the people make up all the different excuses as to why in the world they're going to wait. They're the perpetual people with the perpetual excuses as to why that they will not pull the trigger. I just don't believe that there will be all of a sudden this giant wave of people that will pull the trigger once we have a new presidential administration that's installed. That's not what's going to happen. More than anything, it's going to be where are rates at the time. And if rates start the year below 7% and they stay there with duration, we'll get a more favorable year for 2025. And if they get below 6.5% and stay there with duration, we'll have an even more favorable housing market for 2025. So we'll just have to wait and see. Like I said, we're at the mercy of rates, not at a new presidential administration.
Two different articles I read. One was baby boomer homeowners got rich from skyrocketing house prices. Now they can't find retirement housing. This was written by MSN. The other article was for a study done by Clever Real Estate, revealing that half of homeowners over 56 plan to age in place and never sell. Is there a fix to this issue, or is this something that people are just looking towards for an answer to a larger problem?
That's a clever article. Anyway, I have a head cold, so that's why all these little puns are coming out. But there's been an age in place theme that's been here for a while. This is nothing new. This is just talking about the same old for quite some time. And yeah, you know what? Not too many people. When you talk to people that are retired, there aren't that many people that are going, "Yeah, I want a retirement home. I want to go move to this retirement village or community." That's not really what it is. A lot of people find that their home that they've lived in for a long time, they find it endearing and they want to stay. And that's why that there has been this entire industry built up around them called aging in place. And that industry is for real. It's worth billions of dollars to tap into. So it's a phenomenon that will continue. This isn't going to go away. There's going to be a lot of people that age in place until they get to the point where they have to go to hospice or they have to do something, and that's what they would be doing rather than looking for a place to downsize to or something like that. There's a lot of ways to retrofit a house, even if it's 2-story, to live in a single level or to get to the second level. There are definite fixes to that as well. There's many different ways to carve this age in place environment where people just want to live where they've been for a long time. There's something great about doing it, and there's something awful about moving. Yuck. There's a lot of people that say, man, you have to go through all this stuff. So that's where you see this idea of age in place. But as we get to 2030, there will be more and more baby boomers that are actually forced to sell. lifestyle, either from getting too old or having to go live with relatives or to live in a hospice or in a retirement area just because they're getting too old. That will happen down the road, and it'll start in around 2030 and it will continue, but it won't be this giant tsunami, or what they refer to as silver tsunami. I never liked that for obvious reasons. If you're listening to a podcast, you can't see my silver hair, but it's very silver.
That's what I was going to ask you about. So then you're referring to the silver tsunami. Thankfully, no, we are not seeing anything like that. But what we have seen is home insurance becoming an issue, especially among states like California and Florida. So can this issue become more of a deterrent to prevent people from moving around or into the states that I just mentioned? So could it affect housing prices in the long run, or is this something you see that's not as detrimental?
This too is something that is down the road a bit, but we're already seeing major problems, but we're not seeing it yet in relative to pricing or demand, because both of those still exist. But you can definitely see that some people will hang on to their current assets, not want to move for obvious reasons of not being able to get insurance or it becoming more expensive or different things along those lines. But it's not just California and Texas. There are a number of states that are having problems with insurance. It's just that the states that are having the largest issues with it are California and Florida. Sorry. And Florida is the biggest problem. And it's kind of like given a roadmap as to how big the problem can get. And California, it's like they need to open up the playbook for what's gone on in Florida so that they can figure out how they can mend the fences here. And there's no really good solution to this, but there have to be smart level heads that doesn't matter what side of the aisle you're on, they have to get together and figure out a solution to this in both of these states as well as other states across the United States, because it'll get to the point where insurance is so cost prohibitive that it will prevent people from moving here. It's already extremely expensive to come to California, and now we get this big rise after this big gigantic rise in the cost of homes. You're now getting this big rise in insurance, and that's part of the reason. And you have all these natural disasters. It's not just the natural disasters that are causing the insurance rates to go up. The cost of rebuilding a home has gone up considerably over the last 5 years as well. So that's why we're having a problem across the United States. Now, the problems with wildfires and hurricanes in California and Florida have just exasperated the whole entire thing and brought it to a boiling point where there's a lot of people talking about it, but it has not yet prevented, it hasn't cratered demand, and it hasn't prevented people, a number of people from purchasing to the point where we're getting a reversal in fortune for California. You are getting a bit of it in Florida, but it was already happening prior to the hurricanes, and that's this massive buildup of inventory, and it was prior to the hurricanes, and it had more to do with, and it happened in Boise, happens in Texas, where values had gone up so much and they built so much and so many people moved to those areas that real estate was just bonanza. So we saw the giant increase, bigger than anywhere else in terms of pricing. And now it's giving back slightly a bit of that pricing. And if we get interest rates that are north of 7% for a big chunk of 2025, kind of like they were in 2024, you'll see that those particular areas that I just referred to will actually see prices come down. And it's not our base case. It's not even our second most likely case. It is our third, but it can exist. And if that happens, we'll see values come down more so in the Florida and Texas and Boise, Idaho area and the Tennessee area, but not quite California in all areas, but some areas, yes, in California if we're stuck above 7%.
So you speak of these different cases. You're referring to our forecast, and when are you actually doing this presentation, or at least this live presentation for everyone to see?
So this live presentation is actually, gosh, we're doing this on Tuesday. It's Thursday. I better put that thing together, right? So this is at Thursday at 2 p.m. Pacific Standard Time on YouTube. And YouTube, our handle is Reports on Housing, easy to find. And then afterwards, it will stay up there so you could watch it. But it should be a great forecast presentation. Can't wait to put it together. But yep, it's coming up.
That's right, Thursday the 12th. But Fannie Mae on Thursday the 6th, I believe, issued revisions to its 2025 housing market forecast, dropping its estimated gain for existing home sales next year from 11% to a more muted 4%. Wow. Stephen, is there a realistic prediction for home sales next year? What can we expect? What are your thoughts?
Fannie Mae is all over the place. So they changed their tune considerably because they were looking at interest rates that were 6.1%, and they had forecasted these interest rates to be a lot lower next year. But Fannie Mae, they do an economic forecast and a housing forecast every single month. And that just shows you how much they waver from month to month, which means you can't really rely that much on Fannie Mae. I'd rather talk about the different cases, scenarios. That's kind of the direction that we went to last year because we really are we've got to look at rates, but it's very, very hard to forecast where rates are going to go. So we have to talk about the different cases based upon where rates are and what our most likely case is, rather than it's 11%. Oh, wait, now it's 4%. That to me just doesn't bode well for any kind of a forecast. It's not really a forecast. That's just this is what we're seeing based upon today's news, and the next month. Well, it totally changed over the last month, so we totally changed everything. I'd rather talk about what the direction that we're going, and you'll get that on our presentation on YouTube on the 12th. So you'll see that there are three different scenarios that we foresee happening, and there's our base case, there's our second most likely case, and then there's the asterisk case. Which, by the way, this year, guess what? Which one we hit? Our asterisk case. One that I said was like a 5% chance of happening. That was the economy slowing enough where the Fed really had to do things when in the fall. And that's what they did. They waited all the way till fall. They should have gone way earlier. They didn't. They could have articulated that. We could have had a better year for housing, but nope. Woe is the housing market, and it lined up with interest rates that were not favorable for 2024. So there weren't that many units that were done, and we'll have to see how 2025 plays out. Stay tuned this Thursday.
Well, it's like we know they're not the fastest at making decisions, but at least they make them at some point. That we can be very thankful for. But signaling what would be a housing crash, the 2024 pace of existing home sales is on track to hit a near 30-year low. So what does this tell us about the current state of our real estate market across the US?
Yeah, it tells you how resilient the housing market is. In spite of the fact that we have these really high interest rates, we still have values that have been, slightly up for across the United States, and some metros up a little bit more, and some metros are down a little bit year over year. If you look at year over year numbers, but year to date up for most markets. You know what? You're just not going to get a whole heck of a lot of pushback on pricing right now, and the issue on that is that we just don't have enough inventory. So that's been a problem, and we still have a chronically low inventory. The big news this year is because we had these higher interest rates, there were more homes that came on the market than last year. So, but those extra homes that came on the market this year actually accumulated over time rather than selling because of the higher interest rate environment. So it just depends next year. Do we have a higher interest rate environment where we can accumulate even more so that values will come down? And even if they came down, we're still accumulating to a level that isn't that high compared to where we were like Great Recession levels, which are about 4 times where they are right now. We're not going to get to any of those kind of levels, so we'll not get plunging prices. We could get prices that come down a little bit. There is a case for that. It's not our base case. I need to let everybody know that. So most likely, it's just going to continue to do what it is. Like we have very few units that take place, yet prices remain stable. And you can imagine as rates come down more, what's going to happen? Their prices actually go up a bit. And it will do more transactions because there will be more buyers at play and there will be more homeowners at play as well. So stay tuned to Thursday the 12th to see exactly what we think.
So, for clarification, you're saying that there's not a housing crash that is beginning in Florida, Texas, or in Idaho.
No, what's happening there is there's enough pressure with extra homes in the market, and that interest rates that are higher, they were higher. When they're above 7, it really creates a problem. But when we were down to 6.1%, if we were there for a while, they would have reversed in those markets as well. And you just need to be there with duration. So no housing crash. Yes, values can come down slightly, but that's not a crash. It's not. Irregardless or no, just regardless. Sorry, that's not a word. Regardless of what YouTube says, or these YouTube negative Nellies that are out there beating the drum of crashes and who have changed their tune, by the way. One of the big ones now just focuses on those areas that I've just talked about: Texas, Idaho, and Florida. And like as if the bubble is about to implode. Ooh, boy, yeah, that you need a lot more inventory than what they have, and you need people that are in real pickles, and we don't have that. So while there will be some erosion in prices in those areas, they have prices to give back because they went up so much in value that coming down off of those really high levels still has a lot of appreciation, and they have a lot of equity that they're sitting on, and that will continue to be the case. So yeah, we'll get a little bit of values coming back if rates remain stubbornly high. But if rates stay below 7%, that's going to bode well for even those markets. And if it stays below 6.5%, which it can, that will bode even better for all markets across the United States.
The housing crash talk is too negative for me, so I believe we should end on a more positive note. So recently, I believe you were driving around and you discussed with me how you're seeing all these new builds for apartments that are being built, and lo and behold, in quarter 3, that we saw a record number of new build apartments being built in many years. So what impact could this have on the economy and in rent asking prices?
Yeah, so it was multi-unit completions, most ever in third quarter, ever. That's huge. So it was a record level, and that bodes well because we want to have more housing stock. Unfortunately, it's coming in the form of apartments. We really can use more housing stock in the more affordable ranges across the United States, but there is absolutely no incentive for builders to build them. And they're not going to build them because we want them. They're only going to build those if it makes economic sense. And right now, with all the red tape and everything else, it makes more sense because if they have the same amount of red tape, maybe a little bit more for bigger properties, but they have a higher profit margin on the bigger properties, they're going to build bigger properties. And with value interest rates that have come up, they haven't been able to get away with as big of a property, so there has been erosion on property size. But property size would erode even more if we got rid of some of that red tape and incentivized builders to build more of the entry-level stuff. But at least this helps a bit in creating more housing stock. And a lot of these apartments will actually turn into condo conversions after about 10 years. And that's because condominiums, there's a lot of litigation for construction defects of condominiums, and the construction defect law is there's a 10-year statutory. You have to do it within 10 years. That's the statutory requirements. But now, if they hold on to these apartments that they build for 10 years, after 10 years, it wasn't built within that 10-year guideline, they can go ahead and sell them off at that point as condo conversions. And they won't be able to sue for construction defects. So that's one way around this, that we could see more of that because so many condominiums ended up as in litigation. So this is one workaround for that. And it does add more houses to the housing stock. And even in like a place like Southern California where we are, where it's just starved, and in the Bay Area where it's starved for the more homes that are coming on the market, apartments, it's at least a stepping stone to more units, more dwelling units that are available in counties. So it is a step in the right direction, but I would like to see some more affordable housing as well.
That was a great semi-positive answer. Thank you again, everyone, for tuning in to another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, Bay Area, Phoenix, Las Vegas, or the U.S. in general, especially if you're looking to tune into a beautiful housing forecast, check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. And if you have any questions, like usual, post it anywhere on our social media platforms, or you can email me personally at info@reportsonhousing.com. We'll see you soon and have a fantastic rest of your day. Thank you.
Thank you.